years ago in a simple, boring index fund and never touched it again, do you know what it would be worth today? More than most people make in an entire year from doing absolutely nothing except waiting. So why do so many people still feel completely lost the moment someone says the word invest? In this video, we're breaking down exactly how to start investing in 2026, step by step, without the confusing jargon, the hype, or the risky guesswork. Step 1. Get your foundation right first. Before investing a single dollar, there's one step almost everyone skips, and it's the one that protects you the most. Build an emergency fund first, enough to cover 3 to 6 months of basic expenses, kept in a simple savings account. This isn't about missing out on investment gains, it's about making sure a sudden job loss or emergency doesn't force you to sell your investments at the worst possible time. Invest on without this safety net isn't bold, it's fragile. Step 2. Understand what you're actually investing in at its core. Investing means putting your money into assets that have the potential to grow in value over time. The most common options include stocks, which represent ownership in companies, bonds, which represent loans you give to governments or corporations in exchange for interest, and index funds or ETFs, which bundle together hundreds or thousands of stocks into a single investment, spreading your risk automatically. For most beginners, index funds remain one of the simplest and most effective starting points. Because instead of betting on one company's success, you're essentially betting on the growth of the entire economy over time. Step 3. Time in the market beats. Timing the market. One of the biggest mistakes new investors make is trying to predict the perfect moment to invest, waiting for prices to drop, or panicking when the market dips. Historically, markets move in cycles, periods of growth, followed by corrections, followed by recovery, and further growth. Trying to perfectly time these cycles is incredibly difficult, even for professional investors. Instead, a strategy called dollar-cost averaging works remarkably well for most people. This means investing a fixed amount of money at regular intervals, regardless of whether the market is up or down. Over time, this smooths out the impact of short-term volatility and keeps you consistently building wealth rather than sitting on the sidelines waiting for a perfect entry point that may never come. Step 4. Diversification is your safety net. Never put all your money into a single stock or asset, no matter how confident you feel about it. Markets are unpredictable, and even strong companies can face unexpected setbacks. Diversifying across different industries, asset types, and even global markets significantly reduces your risk. If one investment underperforms, others can help balance it out, protecting your overall portfolio from major losses. Step 5. Match your strategy to your timeline. Your investing approach should depend heavily on when you'll actually need the money. If you're investing for a long-term goal like retirement decades away, you can typically afford to take on more risk since you have time to recover from market downturns. But if you're investing for a shorter-term goal, within the next few years, a more conservative approach, with less exposure to volatile assets, helps protect your money from short-term market swings. Step 6. Watch costs and fees closely. Investment fees might seem small, but they compound over time, just like your investments do. High management fees or frequent trading costs can quietly eat away significant portions of your returns over decades. Choosing low-cost investment options and avoiding unnecessary buying and selling keeps more of your money working for you instead of disappearing into fees. Step 7. Stay informed, but avoid emotional decisions. Markets will always react to news, interest rate changes, inflation reports, global events, and economic shifts. Staying informed is valuable, but making impulsive investment decisions based on short-term headlines or market panic is one of the fastest ways to hurt long-term returns. Historically, investors who stay calm and stick to their strategy during downturns tend to outperform those who panic sell and try to re-enter the market later. The bottom line for 2026 successful investing was never about predicting the next big trend or finding some secret formula only the wealthy know. It's about starting early, staying consistent, diversifying wisely, and giving your money enough time to grow. The people who build real wealth through investing usually aren't the ones chasing excitement. They're the ones who quietly, patiently, let time and compound growth do the heavy lifting. So the question isn't really what's the best investment for 2026. The real question is, are you finally ready to start, or will this be another year you just watch from the sidelines? If this video helped you understand how to actually start investing the right way, hit subscribe for more videos that break down how to build real wealth. And thanks for watching.